So there's a huge distinction in how you choose to build wealth, either as a business person or as an individual.
If you could give someone a piece of financial advice that someone should follow for the rest of his life, and to get to that soft landing that we desire in life all the time, what would that advice be as a consultant?
A financial advice that could help towards wealth building. Leverage. Master leveraging. One of my mentors teaches on this aspect of OPM and OPT. OPM means other people's money, and OPT means other people's time.
Hello viewers, thank you for always tuning in. Welcome to another episode on financial literacy. Today I'm visiting with Mr. Bruno. He's an author, a consultant, a coach, and we'll be breaking down one of a very, very important aspect of our life, right? It's interesting.
I'm excited about it.
Very interesting. And guess what? Wealth building. Everybody wants to be rich. Everybody. Nobody wants to stay broke. Those that are broke are angry. But to some point, you start to ask yourself, like, okay, that is why this show is for you. Make sure you like, subscribe, and follow us, because we already have a couple of episodes on financial literacy. So we are taking it a little bit step more further on wealth building. Mr. Bruno, what does building wealth truly mean beyond having money?
So money is one aspect of building wealth, and wealth covers a plethora of things: knowledge, influence, impact. So wealth has all these layers to it. But I think most people limit their understanding of wealth to only monetary, finance. But wealth transcends that. Getting rich probably can focus on only making money or having money.
Right.
But if you're thinking of building wealth, wealth is something long-lasting and doesn't just stop with money. So I strongly believe just making that first distinction in the from the get-go,
yes,
will set you off right on doing it the right way. Now I have a couple of questions for the person listening to us.
Right.
A couple of questions you have to ask yourself is, are you currently in a position, or are you currently in a financial state that you envision yourself being at this point in your life? All right. That's one. Number two is, I wanted to picture what you do for a living, be it a nurse, be it a doctor, an engineer, an IT professional, and ask yourself genuinely, does what you do right now, or does it have the capacity or the bandwidth or the horsepower to take you where your dreams desire? Because I know we all have big dreams and what we want to achieve, the wealth we want to build, and the things we want to get done.
Right.
Does what you do right now have the bandwidth to take you there?
Wow.
And then lastly, what impact are you making in the world or to the world with whatever you're doing right now? Is it impacting just you and your family or beyond? Those are some basic or critical questions that you start answering that kind of puts you on the path to whether or not you build wealth or live a life that would be, that you could have done better if you knew better.
That's true.
Yeah. So I want us to start from there.
Laying down those questions, which is very key. Let me ask you this. Okay. At what point should someone start thinking of building wealth?
I don't think it's a particular age. I don't think so. The reason I say so is because I've heard of people that passed away in their 20s, and they are talked about till today. So, in my opinion, they left or they built wealth in their short lifespan. We've heard of kids who probably passed away in their teens, but they did so much work that they are remembered for forever. So I don't think it's a particular age. I think you're never too young to build wealth or to start building wealth.
Wow.
I think from the time you get the consciousness that you can be a contribution to the world with whatever your gift is, your calling, whatever it is. Could be dancing, could be communication, could be nursing, could be whatever it is that you feel is your calling. Could be singing, could be ministering or whatever. Whenever you have the consciousness of what you are doing right now can be impactful to the world, I think you can start from there. So as far as I'm concerned, it's not a particular age. Some people can use just 2 years to build substantial wealth. Right. Kentucky Fried Chicken. We enjoy it right now, KFC. The gentleman did not start that until he was in his 60s. I think 60s or
70s, I think.
70s, I think. Yeah. Which means he was almost tapped out.
Yes, he was wiped out.
Exactly. But that is when he built what can be considered wealth.
Conglomerate.
Exactly. But some people are going to live their entire lifetime and never do it. And some are going to do it when they are very, young. So it's to me, it's whenever you can start.
Start now.
Start wherever you are right now.
Start wherever you are right now. Thank you so much for that. This subject is very important and it's very sensitive. Now, in our previous show, you mentioned something, and in most of our shows, you've mentioned it. But I want you to zoom in and break it down more in a very, in a way that a common man cannot miss it. Financial education is very, very important. Now, when it comes to wealth, how important is financial education?
It's the genesis. It's the foundation. It's the ingredient that makes everything work. Because you can't build wealth without financial literacy or financial education. You cannot. It's next to impossible to do it. So you definitely gotta educate yourself, right? If you have no idea how money works, and you have no idea what tools or what systems exist that can help you build wealth, and you have no idea what are the loopholes or the implications or the mistakes you could make so you can avoid them, and you have no idea how markets work or how business works and how everything ties together to help you build whatever it is you want to build, you're not getting there. So financial literacy is the genesis of it all. It starts from financial literacy. Before you can even think of building wealth, you gotta educate yourself financially, because as far as I'm concerned, a substantial part of building wealth is monetary. It's financial. Aside from knowledge and impact and everything else, it's financial. So you gotta first of all start by educating yourself on the basics of how money works and how you can leverage it, the tools and the systems and the platforms available to you. So it starts from there.
You are taking me to my second question, but I want you to expatiate on the different aspects, the different cars that if you really want to build wealth, you need to ride with. What are those platforms that you can leverage in building wealth?
Books are going to help a lot. It's a vehicle, because we're talking about equipping yourself all around.
Right.
So books are definitely going to help. Books on influence and leadership, books on finance, books on business, books on mindset. If we talk of vehicle, the vehicle you ride on, You can have a vehicle all you want. If the engine doesn't work, it doesn't work. Right? And so
That's right.
If your mindset is not right, if your mindset is not optimized, you're not building wealth. You can't last. You can try. A lot of people have tried, but if your mindset is not one that can accommodate the ups and downs, the fluctuations in the journey to building wealth, you're not gonna last. So mindset is a huge part of it. Books, then we can talk of systems, we can talk of business, because anyone that has built anything worthwhile, as far as I know, probably 99%, just give me the 1% for the people I don't know, because I don't know everything,
Right.
have been people that have dived into business. So business is another vehicle they have to ride on, because I'm yet to see someone, an employee, who has built substantial wealth, just earn a paycheck. A few people have succeeded to do that, but there are a handful of them. You can literally count how many
Right.
have actually done it.
Right.
So that the aspect of business is another vehicle they have to ride on.
Wow. You know, when you are mentioning about books, Napoleon Hill, right? Think Rich.
Definitely. Think and Grow Rich.
Think and Grow Rich, right? It's a book that it really applies to. Look at, you remember the book I told you about, Never Eat Alone? It's the title of the book.
Yeah.
When you read that book, you know, look at, there was a summary, you can just Google it and look. The summary of the billionaires in your neighborhood. That's a book, The Rich Man in Your Neighborhood.
There's another one, The Millionaire Next Door.
Yes, The Millionaire Next Door. Then also to look at Rich Dad Poor Dad. Those are vehicles, those are books. There are so much material. We are even going far. Look at Mastering Financial Literacy that you have here, right? Viewers, the link to this book is also going to be put in the description of this video. Make sure you read. I love the way you really put it down. Like, if you have a car, no matter how beauty the outward of that car is, if the engine is not in a good functional state, just forget about it. So education, and we are very specific about that. Financial education. There are other aspects in this education which I want you to shed light on. Right? You mentioned some pitholes where you can do some leverages. You've talked about taxes. You've talked about some debts. I want you to zoom in, right? Those areas that you can really, in our previous shows, we mentioned about we can be going to the same destination, but we have different cars that we need to use to get to that destination, right? Now, when it comes to wealth building, someone is consulting with you. What type of cars can you really advise them or guide them that they can use where they can really build wealth?
All right. So I'm going to break this down chronologically, how I see it and how it's worked. And leveraging books and research and talking to a lot of successful people, you realize that most of them, if not all of them, have done it this way. So you have to, first of all, build wealth the right way. Okay? So before we talk about vehicles, the genesis of wealth, when you're building a house,
right,
the first thing you do is lay a foundation.
That's right.
You lay a solid foundation.
Solid foundation.
That can withstand wind and rain and everything else. What happens if you ignore the foundation? If you just go put up the walls and slap a roof on there and paint it as beautifully as it may look, when the winds come roaring and the windstorm, everything is coming down.
Right.
And that is a mistake a lot of people make in their quest to build wealth. So yes, we can talk about vehicles. Vehicles is the last aspect of building wealth. The first aspect of building wealth, and we're speaking to predominantly immigrants.
Right.
So we're addressing what matters. The first layer of building wealth, the first block is protection. You gotta lay a solid foundation on which to stand on.
Right.
And you live in the United States. Protection is key.
Very important.
Everything.
Very important.
The reason why the business of insurance is so lucrative and is so embedded in this culture It's because they understand that aspect. That's why America is the wealthiest country on earth. For that reason.
Insurance.
Insurance.
Go deep. I really want to know more about this. Go deep. Yes.
So, if you walk into a dealership,
yes,
to get a car, they don't let you sign any paperwork if you don't show proof of insurance. So they before they take your money, they make sure you have protection first.
Wow.
All right. I got to tell you something.
Right.
I'm peeling the onions here.
Yes.
When you're buying a home, imagine if you're putting down 5%. The closing day, if you don't show proof of insurance on that house, you've not even signed the papers to the house.
Right.
It's not your house yet.
But you need to show proof of insurance.
Before you sign those papers, they need proof of insurance. They need assurance that someone can take care of that responsibility if things go south. Okay?
Yes.
So when it comes to us, if you're trying to build wealth, what is your protection? Because the car is insured, the car is protected, the home is protected, but now we're talking about you. You are trying to build wealth.
Right.
So what are you protecting, or what have you protected? So you can't just skip to vehicles.
Right.
Without taking care of the fundamentals, the basic, the genesis of it all. You need protection. You are buying a car, so you protect the car. You're buying a home, so you protect the home. But you are building wealth, so you got to protect you. And that is where, and what can protect you in this economy? Life insurance.
I love the angle of which you are bringing. And let me add another aspect too, right? You go to Walmart, when you are checking out, you buy a simple tool, just maybe like a screwdriver. They'll ask you for protection plan. That's insurance.
Exactly. When you book a flight,
they'll ask you safety.
Yeah.
That's insurance. Everything
has to be insured.
Let's keep that side apart. Tell me, on this human protection that we neglect, we insure everything, but when it comes to ourselves, which is one of the key aspects of wealth building, we neglect it. Zoom in, zoom out, and break it down to a layman so that someone watching this video can really say, look, this is what I need to do, these are the steps I need to take, and this is the expected result I need to get.
You know, there is one thing guaranteed in life. One thing. Death.
Death. Unavoidable.
Someone jokingly said they did a research to find out how many people get out of life alive, and they discovered nobody. Nobody escapes death.
Right.
But it's disturbing to know that it's the least talked about thing, or feared. Let me say feared. So when you mention the word protection and insurance in the same sentence, that, or insurance in the, and life insurance to be specific.
Right.
There's a lot of negative attributions to life insurance, because the one word that comes to mind when you mention life insurance is death.
Death.
And we don't want to talk about death, so we ignore the insurance. All right. So it is important to understand what different protection plans are out there, and there are multiple.
Right.
All right. There are different insurance protections, and over time it's evolved. I'm not a fan of someone that tells me there's only one way to do something. There are multiple ways to do,
right.
different ways to do a thing, and you pick and choose what works for you, right? So the basic of it all is have some sort of insurance, whatever works for you. Start with the basics. There is group insurance that most jobs offer. There's some sort of insurance. There is term life that you can get for yourself. Most banks offer it. Some professionals out there offer term insurance. That means you're buying protection for a particular period of time. Could be 10 years, could be 15, 20, 25, or 30 years. You decide how long you want it.
Right.
And some are renewable, all right? So you decide, okay, I'm going to be paying this much for this much coverage. So if something was to happen to me, worst case scenario, death in this case, right? My beneficiaries or my family can get something. Now, there are some types of term that include living benefits to it, which means if I fall sick in my path to building wealth and I can't afford to take care of my family anymore, I can use my life insurance now that I'm still alive, not wait until I'm dead. So there are some term insurance policies that add that as a rider that you can use, right? So you can talk to a professional, any professional, ask them for a term life with living benefits.
Right.
Then there are more long-lasting policies. These are permanent types of policies, like a whole life policy. The whole life policy can last up to 100 years, all right? Some of them are participatory, which means you can accumulate some returns in those. Some of them are non-participatory, all right? So it's just a straight whole life. It can last all the way to 100. And then we have universal life policies, right? Those are, we have variable universal life policies, which means you can make returns based on market performance, all right? You can participate in the ups and downs of the market. And then we have index universal life policies, which means you can get returns based on the underlying index, all right? These are just different types of protection plans. So you can get what works for you and what you can afford. But you need that foundation. That is the point we're trying to make here. It's not specifying to get this and not get that. It's that you need that protection.
Irrespective of the direct one.
Which one it is.
Yes.
Irrespective of, you need that genesis to start with.
When you even dream of wealth,
yes,
that's the foundation which protection is very key.
It is the genesis because, when we're talking about wealth,
right,
we're talking about something that is going to outlive you.
That's true.
Yeah. So
that's true.
So if you're gone today,
what next?
Or tomorrow, or next year, or 10 years from now, what are you leaving behind?
Ooh.
So that protection is key. Because if you're genuine and if you're true to yourself that you want to build wealth, it has to be something that outlives you. So if you pass away today and you have no savings or investment, what outlives you then? The financial backing,
yes,
that you're put aside. You're writing a check up front and telling your family, I love you, I care about you guys. And if something was to go south in my journey to building wealth or in this path we're on right now, I still want to make sure you're protected and something's left behind. So that's the foundation of building wealth. You cannot build sustainable wealth without laying that foundation. Insurance, it is key. Second to that, after you've laid the foundation, most of us have already made the mistake of getting into debt. We cannot avoid it.
Dive into that, because that was taking me into my next question, that we fail to understand the importance of the right foundation, because everybody's laying foundations, right? But nobody is laying that right foundation. I wanted you to break down why have we failed, or why are we ignoring, or why are we not actually using the right tool to lay that foundation, the foundation you just explained here. What are those aspects that are hindering us from laying that right foundation?
Okay, great. So if I can give the 4 steps involved in building wealth, we talked about protection. Second, debt management. You got to manage debt,
right?
Because this is going to hinder your ability to build wealth. Debt. All right. Imagine you tie a big chain in your neck and you're trying to run. You're trying to run 100 miles. You can't go far.
You can't go far. Not at all. Not at all.
If at all you move an inch, but you can't go far. So debt management is key. Then the next one is you got to set up the right contingency plans in terms of emergency fund, because that again can bankrupt your abilities to build wealth if you have nothing to fall back on. I'm gonna go into details though.
Yes.
But we'll talk on protection. We'll talk on debt management. We're gonna touch on emergency funds or contingency plans, and then we talk about the vehicles, which involves investing. The last aspect of building wealth is where most people focus. Explaining why they never build wealth. because everyone focuses on the last step, which is investing. And investment carries risk. So when your investments go south and you have no emergency fund and you're drowning in debt and you have no protection, you're toast. So lay the right foundation first. Now we're on the second one, managing debt. You have to, in the first episode I said, if you find yourself in a hole, you stop digging.
Stop digging.
Most of us already find ourselves in
that hole.
Struggle, debt. You have to strategically navigate your way out of it. And it's going to be slow. And you got to accept the fact that it's going to be slow.
Right.
But it has to be progressive anyway. So if you find yourself in debt, there are two methods that I write in my book. There is the avalanche method and the snowball method. You choose whichever works for you. Avalanche, if I can just explain.
Yes.
Is you gotta be honest with yourself. This requires a lot of self, evaluation, and be genuine with yourself, of course.
Mm-hmm.
If my ambition is to build wealth, I already find myself in $50,000, $10,000, $20,000, whatever thousand in debt, multiple credit cards, multiple maybe school loan, maybe car loan, maybe whatever. So you gotta sit down and write everything down. So list all the debt, all the bills you have. Let's say you have 4. School loan, credit card, car loan, maybe 2 credit cards or whatever.
Mm-hmm.
You've written down, maybe mortgage, so 5.
Right.
You've written them everything down. Right alongside them, there are interest rates.
Ooh.
Which one has the highest interest rate? So your credit card may have a 28% interest rate. Your school loan may only have 4% interest rate. Your car loan may have 6% interest rate. Your mortgage has a 3% interest rate, and everything else. So you write them in the hierarchy of how much interest you're paying on those credit cards. Then you target the one with the highest interest rate first. Because you're trying to avoid the problem compounding. If you start with wherever you start, for example, if you have a 25% interest rate on a 2,000 credit card, for example, but your home has a 3% interest. If you focus on paying off your home, that has a huge balance. And ignoring this one. Before you're done paying off your home in how many years? Imagine how the way this is going to be.
The 28% loan has already compound.
So with the avalanche, you focus on the one with the highest interest rate. Pay that off. Then you focus on the one with the second highest interest rate, then the third highest interest rate. So you pay them off in terms of interest rate because you're trying to avoid the compounding. You're trying to stop digging. All right. So that's why you focus on paying off them in that order. That's the avalanche method. The snowball method is if you're looking for small wins that can motivate you. Same thing. You're going to list every debt you have, but in terms of amounts. Which one has the highest balance could be your mortgage. The second highest balance will be your school loan. The third could be your car loan. The fourth could be a couple of credit cards and all whatnot. You list them in that order. Then you start with the smallest one.
Cleaning up.
You start cleaning up. So you start with a $500. And if you successfully pay off the $500, then you snowball all of that amount because now you have an extra $500. And that's a mistake a lot of people make. When you're done paying off a $500 credit card, it means now you have extra $500. That should be snowballing to the next one, to the next debt, to the next debt, of course.
Right.
You finish paying that off, then you have an extra, all that extra that you'll be putting in the first 2, you pull all of that and put in the third one. So you can pay it off that way. Now, let's say you are in a place where you cannot even afford to use any of these methods. There are other ways to get out of debt. There is loan consideration or credit consolidation. It means if you have 4 different credit cards, you can consolidate them into one.
Oh.
So you have credit cards with 15%, 20-something% interest rates. Credit unions are fond of doing consolidations. Call a credit union around you. Say, hey, I'm trying to pay off my debt. So I'm looking for a loan to pay off my debt. They're going to give you a loan at maybe 6%. One. If you have credit cards that sum up to maybe $20,000 and they give you a $20,000 loan to pay off those credit cards, then you only have one bill to pay, which is at 6%, compared to 28 plus 16 plus whatever. You combine them into one. So you're paying just one bill to the credit union, and they're happy to do that, by the way. They're happy to do it.
Wow.
That's another way to go about it. If the worst comes to the worst and your income cannot even permit you do that, let's say you've defaulted on credit, you can use there are credit settlement companies that can work with you to negotiate on your behalf. You can actually do that work by yourself. You've defaulted on a credit card and you've not paid it for a while, and you've stopped paying it. There is a period they're going to wait for you to make those payments, and if you can't pay them, they can call to negotiate with you. Let's say it's been 6 months or a year and you've not made any payments. They know that money is not coming. Yes, it's going to hinder your credit score, but at that point you're trying to stop digging. So your credit score at this moment, because you're trying to fix things,
right?
And sorry if I got a sidebar. A lot of people are so concerned. Your credit score is very important. Don't get me wrong. But when you're already in a dilemma like that, your credit score is the least thing you should be thinking about. I see a lot of people try to protect their credit score so much that they don't want to seek solutions that can help them out. I would rather my credit score take a 2-year negative so I can dig myself out of debt than build the right way, than try to pamper a credit score that is still getting dragged by the overextended, credit cards. Which this method I'm talking about is going to hinder your credit score because you've defaulted on the loans anyway.
Right.
You've already defaulted, so you've already reported it to the credit bureau. So I don't know what you're trying to protect anyway. So you work with those credit companies. They're going to negotiate on your behalf. They're going to call the credit companies and be like, this person has no income or has limited income. They can't pay anymore. Let's work something out. It's $5,000, but they can't make any payments. And
right.
They have not paid for 6 months or 1 year. So you're not getting any money even if you keep waiting. And the credit company cannot sue you. They can lock you up. So they have to negotiate. So they're going to say, okay, you know what? We're willing to close this thing. We want to charge it off at $800 or $1,000. So all you need to pay us $1,000 and we close this off. You can have a payment plan with that company to just pay off the $1,000 needed to charge that credit off. That's another way you can go to pay off the credit card. I don't want to extend all the way to bankruptcy because bankruptcy has a lot of implications with it. But I'm looking for you to just get out of debt management. If you can be able to do that, you can liberate a lot of money that can go towards the last 2 things on your path to building wealth. Create contingency plans. Because this is how I look at it. If you have no emergency fund, which in the beginning should not be something substantial, just try to put away $1,000. Typically, we recommend 3 to 6 months of living expenses should be sitting in your emergency fund. Right? We can talk of where exactly, but 3 to 6 months of living expenses should be sitting in an emergency fund. That means if you are impacted by anything, laid off from your job,
6 months worth of savings to cover you.
Of living expenses should be able to take care of you. So that's the purpose of an emergency fund. Because this is what happens. There's a research. I don't know specifics on percentages, but there's a huge percentage of people who cannot afford a $500 emergency. $1,000 emergency.
COVID came and there's a book that I wrote the book, but I end up not publishing the book. It's still just lingering on my desk. The positive impact of COVID. And in that particular book, I remembered I was a victim too, right? Where I really needed to look at savings from a different perspective because I was caught in a web. No job, nothing. What's going on? Nothing to fall back on. And COVID lingered for what? More than a year. Almost 2 years. The whole entire world was grounded. So I love this contingency plan that you are really trying to break here. The importance of it. I really want you to go further as a consultant, helping families, educating families. I want you to lay more emphasis on this contingency plan.
You need contingencies for your health, your finances, unexpected occurrences, things out of your control. Sickness doesn't knock on the door before coming in. Your company that you so love and cherish They don't tell you when they're going bankrupt. You have no idea what's happening upstairs.
That's true.
They don't consult with you. They don't care if your wife just gave birth, or you just started building a home, or you just bought a house yesterday. They don't care.
That's none of their business.
Corporate cares about their bottom line. Are we meeting the bottom line? If we're not, then we gotta let people go. And who are we letting go? Bruno. So who is advocating for Bruno in that boardroom when they're saying Bruno has to go?
No.
We're paying him $100,000. He's a liability right now. We want him, but we cannot afford him. All right. And Bruno's wife just gave birth. Bruno just fell sick yesterday. No one cares if Bruno is okay. No one cares. You're let go. So in that state, it's going to take you a couple of months to probably get another job. So in the meantime, then what? So you cannot ignore savings or creating a contingency plan. Not because you're expecting it to happen, but you insure your car not because you expect to get into a car accident. No one is praying to get into a car accident.
Right.
No one wakes up and say, man, it feels great to get into a car accident today. No one does that. But you insure your car anyway. Your car, that insurance is your contingency plan. If things go south, and even if I'm not the one responsible for this accident, maybe someone else is sleepy on the wheel and hits you. You still need that contingency plan. You need it.
Wow.
You don't have to be responsible for it, but you need it. So it's important to put contingency plans in place, right? In your health, most people have a health insurance from their jobs, mainly from their jobs, which means if you lose your job today, you have nothing else. Right?
That's true.
Because I consult with people and I tell them, your job, your insurance from your job is important, your health insurance, but it pays for the medical bills only. It's not going to put food on your table. It's not going to pay your mortgage. It's not going to pay your rent. It's for medical expenses only. So let's say you fall sick and you're actually in that hospital and your health insurance is taking care of your medical bills. Who is putting food on your table? Who is paying for your rent? Who's taking care of the family? That's why you need a contingency plan, right? And earlier I talked about protection and some different policies or life insurances that add living benefits. That's where your living benefits can come in. If you have the right type of insurance that has that provision to it, you can now leverage that to take care of your personal bills. But if you had an emergency and you're building right, and you have $1,000 saved, you have 6 months or 3 months of living expenses. Even if you're at the hospital, the last thing on your mind is financial stress. The last thing on your mind. You can focus on getting well. The reason why most people pass away, prematurely, is not purely the illness. Yes, illness is the stress that comes with the illness. It's that you're laid on the hospital and you've lost your ability to make money, but you're still expected to bring money to the table, and you can't do it. And there are people and things depending on you. That stress alone escalates the illness and takes people out faster than they were supposed to. So a contingency plan is very important. You cannot ignore it, right? Imagine if you have a tire puncture, right? In your path to building wealth, if your contingency plan is a credit card, you're going to swipe it in that scenario because you don't have any emergency fund. So you swipe the credit card, and guess what? You're back to step number 2. You're back to managing debt. You're back to digging the hole again. So you cannot ignore that contingency plan. Save an emergency fund. And then the last stage, I hope I covered enough.
Yeah, I love the way you really breaking it, which is go to the last. You mentioned 4, yes.
Yeah. And then the last aspect of building wealth is investing.
It's investing.
That's the exciting part. Everyone wants the exciting part. They don't like the boring and most important part, by the way. The boring, most important parts are the most important, right? Are the foundational, aspects of it. The interesting part or the exciting part is investing. Where do I invest? How do I invest? Teach me how to invest. And I'm like, nah, we're going to go back to Genesis. If your intention is to build wealth, I cannot just tell you where to go put your money. It's not going to help you. So I start with you. If you're intentional, I start with you from the Genesis. What plan am I going to put in place for you to make sure you're protected? Not just for you looking at me, but the people that depend on you. Because the other misconception with insurance is that I don't want to get insurance. And I tell people sometimes, you're not getting it for you, by the way. You're getting it for the people that depend on you.
Right.
Which is the people that are dear to you. Your family, your kids, your wife, your spouse, your parents. You're getting it for them. All right? So, investing. That's where you now position your money in strategic places to grow and multiply and make more money for you. The stock market, real estate, businesses. That's the exciting part. But if you're going to build wealth, long-lasting and sustainable wealth, you cannot skip steps. You cannot. You got to build chronologically.
It's very interesting that there are some of this key stuff where we excited about them, but at the end we don't know. Which takes me to my question. I want you to zoom this in when it comes to investment. What mistakes do first-time investors commonly make?
I was listening to a gentleman. Okay, I call him a gentleman. He's a pastor. He's Pastor Emmanuel Iron. I think that's his name. And he mentioned something I'd never heard before. He said the Dunning-Kruger effect. In my head, I'm going, what the heck is that? The Dunning-Kruger effect. And the context behind it is he went to business school. He went to go do his MBA. And he was fascinated at how much knowledge he was getting in that classroom. And he thought to himself, there is no way the average person out there can succeed if we are both competing in the same marketplace. And I've been exposed to this much. There is no way my level of understanding of the market and the system that are involved is way superior to yours. So there's no way you're beating me. You're trying to compare with me, but you have no idea. You think you know, but you don't know anything. Right? So I kind of reference that to investing. The genesis of investing has to start with knowledge, understanding the different platforms and tools and systems out there. A lot of people jump into tactics. Show me where, show me what. But you don't understand the mechanics behind it. So let me give you something more concrete here. There is this gentleman was interviewed. I think he's the founder of one of the biggest hedge funds on Wall Street. And he said the stock market is engineered for the little man for the little guy to fail. They don't just know it yet. Because he said the average person, the average trader,
right,
the person trying to trade stock, buy and sell, they're trying to click buttons and see when the market is going up, time them, but they have machines doing that for them. So these machines now with enhancements from AI, they can already detect the movements of the market. They can already sense when to buy, when to sell, automatically without them clicking. That's what you're competing with. So the idea that you can do it better than them is false.
I remember in our previous show, you mentioned something. Rich people stay in the market, poor people time the market.
Yeah, it says time in the market is far superior than timing the market. So the wealthy believe Warren Buffett is a great reference.
Very great reference.
Buys, he
holds.
Because he knows the profit comes later. It's going to take time for this thing to compound and grow. The average person is trying to jump in, buy, sell, and you realize at the end of the day, you didn't really do much. And I did that firsthand to know. So I'm speaking from experience, not just hearsay. I tried doing that. I tried trying to play the game. And after doing that for a couple of years, I discovered I was going nowhere. I don't know about you, but there's the majority. If you look at how many people out there genuinely make money from trading, very few. I'm not saying nobody makes money from doing that.
Right.
There's a handful of people. So investing has to start from knowledge. Educate yourself. You gotta educate yourself on what exactly you're trying to invest in. Real estate, Airbnb, whatever, any exciting thing out there, you got to make it a study. You have to make it a study.
It still boils down to, at the top of the show, we mentioned about financial education. We in all our episodes, financial education is very, very important. You can't take that out of the equation, not at all. This is very, very important. We focus more on the last part, but we don't really sit down to focus more on those great parts, as you mentioned, that when you have a sit down with someone that you are really counseling, right? They are excited. What stock should I buy? What are the predictions of the market? Just like Vusi said, right? I love that guy. Very great guy. Very, very important. Let's not forget about this part. Even though we want to invest, but let us first of all go and lay that foundation. So viewers, you can consult Mr. Bruno, get to him. His business contact will be displayed at this description of this video. So he's available. He can break more down to you. I love the way you break down those 4 aspects, right? When it comes to wealth, which is very, very important. Now, when we come in here, we love clock in, clock out. We love to go, let's take job 1, job 2, right? Then we take overtime. In the realistic world, when it comes to wealth building, how far does 9 to 5 contribute?
It's the genesis. It starts from there, but should not end there. It starts from 9 to 5 because at the end of the day, it's survival.
Survival, indeed.
As an immigrant, you need to survive.
You need to.
And that is the easiest way to do it. That's the easiest way to do it. Some people have come here and actually, from the get-go, jump into business, like straight up. I know a lot of people who have done that, who come here and have never worked a 9 to 5 in their life. Wow. They come here and figure out a business to start and actually start the business. Right? So a 9 to 5 is where most people start, is where you should start, and do it for long enough to build, enough capital to want to branch out into, a business. And don't just take it from me. Look around you. History is a great teacher. You look at your neighborhood, you look at your community, you look at the people around you, and ask yourself, who is considered successful in whatever community you're in? You could be in Canada, you could be in the US, you could be in Memphis, you could be in Tennessee, you could be in Missouri or Minnesota or Texas or wherever. Look around you and tell me, who is considered successful in your neighborhood? And what do they do? All right? What do they do?
Wow.
And it's gonna quickly, reveal to you that most, if not all, of the people considered successful are entrepreneurs, are business owners. So it's not just me saying, don't work a job, don't work 9 to 5, go get a business. No. I'm not preaching that. I'm saying you do the research and come to the conclusion yourself. And when you realize it's entrepreneurship, which I realized back in 2019. I realized that in 2019. That's why my path from 2019 has been totally different from what I used to work in IT for many years. But I started shifting from 2019. I went into real estate, medical center, medical services, then financial services now. My path started shifting when I realized that everyone else is just going to school, getting a job, and then working that until they retire broke. Most people, not all.
Right.
And my path, I wanted to build something sustainable.
You wanted to change the narrative.
I had to start putting things in place. And it didn't happen in 2019. It took me 3 years to eventually say, okay, I'm at a position where I can step away from my 9 to 5 and now focus on business.
It's very, very fascinating. You mentioned some pithole, because we're talking on financial literacy here and we're looking on wealth building. At the top of the show, you mentioned about taxes. I want you to zoom in there and really dissect, butcher it to you understand what I'm saying?
Right.
Because let me take you back from Cameroon. If you look at how they were saying that they want to digitalize taxes, you know, back home people have been messing around. They can deviate taxes and all not. And then when you come like here in the United States, taxes is one of the things that you don't mess around with. You mess around, IRS is going to come behind you, and you know when they are beginning to come behind you, it's a big different ball game.
Definitely.
Now, want to build wealth. In our last episode, you mentioned the fact that taxes is one of the important things that hinder us from building wealth. I want you to take it a little bit, a little step further.
There's a precedent. There's a United States precedent that said something. You know, earlier I said there's one thing guaranteed in life:
Death. Yes.
Now in the U.S. there are two things guaranteed. Death is still one of them. Taxes is the next one. Okay, taxes is the next one. Is the next guaranteed thing in the United States. You have to pay taxes. You must pay taxes, and the system is designed for you to pay taxes multiple times. We say double taxation. So for some people, it's quadruple taxation. They don't just know it. Now, let me give you a scenario. You work a job. You do the work yourself. The IRS take a cut from your paycheck. That check comes to your bank account. You put some of it in your savings. You make anything above $10, you pay taxes on the interest you make on the money you already paid taxes on.
All
right? Then you put them in the stock market, for example. You buy stocks. You're trying to invest. You make profit. You got to pay taxes on that profit. You go to the store to go buy grocery for your family or for yourself. When you're checking out,
pay taxes.
Pay taxes.
Massive.
You buy online, you still pay taxes. So how many times does a dollar get taxed? We will ask the average person to tell you once when I'm paid. No. You pay taxes multiple times. So yes, when it comes to wealth building, you cannot ignore the topic of taxes.
Wow.
And what separates those who actually build wealth and those who don't is heavily dependent on how they are taxed. So let me break it down. A W-2 earner, you have a job. Before your paycheck hit your bank account, the IRS already took their cut. All right? They already took a cut. Some people have no idea how much percentage of their paycheck goes to the IRS. That's why they're surprised at the end of the year. Like right now, we're in February. Some of them are going to be smiling. Some people are going to be crying. And those who are smiling are those who think that the IRS gave them money. What the IRS does is this. They know if you're single, if you're married, they know what percentage of taxes you're supposed to pay to them.
If it exceeds.
Now, if it exceeds what they were expecting from you, then they refund you.
Right.
They're refunding what you gave them. It's your money. They're not just manufacturing money to give you. That's the illusion that most people have to wake up to. And if they realize they took less than they were supposed to take, you're supposed to pay them.
Pay them back.
So that's one aspect of it. So the IRS takes their share before they pay you. Secondly, you cannot write off personal expenses. When you make a paycheck, if you're going to take a vacation with your family, you got to save up for that. If you want to buy a computer or you want to buy a phone or buy whatever food, you buy gas. You're spending you're spending your own money.
Right.
All right. Now compare that to a businessman or business owner. First of all, their money is not taxed upfront. They make their money. It comes to them. They get to spend it on their business, and their business may involve buying a new phone.
You are mentioning now those on 1099.
Yeah. 1099 and even business owners.
Yes, right? LSE.
Yeah, because they get to spend on their business.
Right.
They have to keep their business running.
Right.
So they get to spend on their businesses. Could involve buying a new couch for the office or for whatever, if it involves their business. Could involve meeting clients out of state. That includes travel. Could involve driving to a client that involves gas. Right. Could involve buying a new phone or laptop or a couch or anything that would help them run their business. Which are what? Most things that are personal.
Right.
So they get to write off all these extra things as business expenses as well, legally. Everything is legal.
Yes.
All right. They can pay their kids if the numbers escape me, I think it's $14,600 the last time I checked. $14,600 is how much the IRS can allow you pay your kids legally.
Oh wow!
For helping you run your business. They could be cleaning the floor, they could be putting away documentations or creating flyers for you, helping you with your business. You can legally pay them $14,600 a year. From the age of, if I'm not mistaken, is 7 or 8 years old till they're 18. So look at how much money we're leaving on the table.
Jeez.
Exactly. That is just some of the aspects. That is just some of the taxes, double taxation, so to speak, that could go towards helping you build wealth that we're ignoring or we're not taking advantage of, right? So you can compensate your kids for helping you build your business. From the age of 8 years old to 18, if I'm not mistaken, the IRS gives you a provision to pay them up to $14,600 a year, if the number is correct. I think the amount is accurate. $14,600 a year for helping you build your business.
Right.
They could be cleaning the floor, running errands. It could be, receiving phone calls, or creating flyers or whatever is helping you run your business. You can legally add them on your payroll. And that money can then be put into their college fund or whatever it is that you want to. So there's a huge distinction in how you choose to build wealth, either as a business person or as a W2.
It's very, very fascinating to me because I didn't know that. Let me be very truthful about that, which is very, very important. So once again, this is a show that it's not just for watching sake. Take practical steps because wealth building is very, very important, right? We love to, talk about wealth, want to live wealth, but I don't think that we are really being educated, right? And also too, you need to play your own role. You watching, take practical steps to really prove to the point that you are really following, right?
Definitely.
As we're rounding up, I want to ask you one question. If you could give someone a piece of financial advice that someone should follow for the rest of his life, and to get to that soft landing that we desire in life all the time, what would that advice be as a consultant?
A financial advice that could help towards wealth building. Leverage. Master leveraging. One of my mentors teaches on this aspect of OPM and OPT. OPM means other people's money, and OPT means other people's time. In your journey to building wealth, you have to leverage.
Wow.
You have to leverage other people's knowledge, right? You have to leverage other people's resources. You have to leverage other people's platform. You have to leverage other people's environments. And most importantly, if you're talking of investing, you have to leverage other people's money. And the earlier you can get to where you understand what I'm talking about, the better for you. Now, in terms of other people's money, the rich have figured out how that works perfectly. Because what happens to the average person? You make money, you take it to the bank.
You see,
You put it in your bank account. And the bank says you've given us physical cash, and we're going to show you numbers on your phone that represent the amount you've given us. So you wake up at 2 a.m. The average person, there was a study that was done. The average person looks at their phone in a day. If I'm being very modest, it's about 100 to about a couple of thousand times at their bank account, to be specific.
Yes.
In a day.
Wow.
That means the time you just open your bank account just to check, and then you're done. Check. And this, I saw this. I was attending not soccer, American football. I was attending a football game in Minneapolis, and I was sitting behind this gentleman in front of me, and I saw this happen live. I was not trying to sue or whatever, but the seats are your
Right.
So you can see what the person behind next to you is doing. And I observed this happen live. He checked his account, I don't recall how many times, and he had multiple accounts. But I know the logos for Bank of America, US Bank, Wells Fargo. I saw him open Bank of America multiple times. Just open. I'll see him just check, click, put his password, open it, close it, go to the next one, open it, close it, go to the next one, open it, close it. The whole time. When he's bored, he opens it, and he would go to his bank accounts and keep opening and closing, opening and closing. That happens to the average person multiple times. You're checking to see a number to feel good about yourself. All right? But if you've never tried this, try it. If you have anything above $10,000 in your savings, walk into your bank and tell me you want to withdraw the entire amount. You're not going to get it. You're not going to get it instantly, is what I mean.
They will tell you to apply or to write or to wait.
Come back maybe the next day or a day, because your money is not just sitting there waiting for you. So someone else is leveraging your money.
Ooh.
That person is not you.
Ooh.
The bank is leveraging your money, and someone that lend your money out to is leveraging your money. So, OPM, other
People's money.
You gotta get to a point where if your intention is to build wealth,
Right.
you're gonna get to a point where you're leveraging other people's money. For example, if I buy real estate, I own property rental.
Right.
So I leverage other people's money, because I go to the bank and say I want to buy a property. They say, how much do you have? I have 20%. 20%. If you're going to buy a business property spread out, 20%. They say, okay, bring the 20%. Let's say 20% of 400,000, 10% 400,000, 40,000, 20% 80,000. So they say, bring 80,000. If I bring the $80,000, what is lacking? 320,000. Where is 320,000 going to come from?
The bank.
The bank. Where is the bank getting the money?
Other people's money.
Exactly. So I'm leveraging other people's money to make money for myself. So you have to get to a point where you can do that. Then other people's time. Businesses run on other people's time.
Right. That's why we're clocking.
Exactly. Because someone had a vision to create the company you work at right now.
Mm-hmm.
All right. They're leveraging your services and paying you for your time to help them build their dream. So they're leveraging your time, a portion of your time, 8 hours of your time, or 16 hours of your time if you choose to do overtime. Right? So that is other people's time. So you got to get to a point where you're equally leveraging other people's
time to make wealth.
And it's not you using people. No. That's the illusion. It's not you using people, it's paying them what they're worth.
Right.
If someone decides that their worth is offering their time to you, then you pay them what they're worth and use their time. So if you're going to build wealth, you got to maximize other people's money
and other people's time.
It's just called leverage. You got to leverage.
Thank you so much. I love the way you summed that up. Once again, thank you so much for coming in. We've come to the end of this show. I'm your host, Innocent. And I was visiting today with Mr. Bruno. Thank you so much as always. Once again, his books are going to be displayed in the bio or in the description of this video. Make sure you educate yourself. Read books on financial literacy. Thank you so much, Mr. Bruno.
Appreciate it. Thank you for having me.
Thank you.
Awesome.